The best performing accounts at Fidelity during major market crashes belonged to investors who were dead or who had forgotten their passwords. They were not running clever strategies. They were just gone. And while everyone else panicked, sold, and waited for the bottom, the absent investors quietly won. Not because doing nothing is a strategy, because panic is a guaranteed losing one. Your brain is wired to treat a portfolio drop like a physical threat, and that wiring costs the average investor hundreds of thousands of dollars over a lifetime. In the next few minutes, 6 moves that actually hold up when markets lose their minds. And the reason almost no one uses them, even though most of them sound obvious. The first one matters more than the other 5 combined, so stay with me. Studies of investor behavior over the last few decades keep finding the same gap. The market returns one number. The average investor earns roughly half of it. That difference does not come from bad stock picks. It comes from behavior. Buying when prices are high because everyone else is buying. Selling when prices are low because the fear has become unbearable. Making perfectly logical decisions at perfectly wrong moments. Researchers at Stanford have shown that financial losses light up the same region of the brain as physical pain. The same circuit that fires when you burn your hand on a stove fires when your portfolio drops 30%. So you are not processing a number on a screen. You are processing a threat to your survival. That is why smart people make terrible decisions during crashes. Their brains are not running rational software anymore. They are running the panic response that evolved on the savannah, badly miscalibrated for a 401k. The 6 moves you are about to hear are not just financially sound. They are psychologically sound. They work specifically because they assume you will be terrified, irrational, and desperate to do something. Anything. They are built for the version of you watching futures crash at 2 in the morning, not the calm version reading a personal finance book on a Sunday. Move 1. The automation firewall. The single most powerful thing you can do before a crash hits is remove yourself from the equation entirely. You already know you should keep investing during a downturn. Every advisor on the planet will tell you that. But knowing and doing are separated by an ocean of cortisol. Research from the University of Chicago found that investors who stayed automated through the 2008 crash ended up significantly wealthier 10 years later, compared to those who paused contributions and tried to time their re-entry. Not because they were smarter, because they never had to make the decision in the first place. So you set up automatic transfers, automatic rebalancing, set them once, and intentionally make them annoying to change. Some people use separate accounts at different banks specifically so that stopping a transfer requires a phone call, a form, real friction. Why does this work when willpower does not? Because willpower is a depleting resource. Psychologists have demonstrated for decades that your ability to resist impulses drains throughout the day, and it drains faster under stress. During a market panic, you have almost no willpower left for financial discipline. Every ounce of mental energy is being spent managing the fear itself. There is nothing left for the rational override. Automation does not require willpower. It does not require discipline. It does not require you to be brave at 3 in the afternoon when the headlines are screaming. It only requires you to set it up before the panic starts. You are not weak for needing this. You are running human firmware. And human firmware is bad at staying calm while a survival circuit is firing at full volume. That move alone changes the math for most people. It only works if the next one is in place too. Without it, every other move on this list collapses the moment the market turns ugly. And almost nobody has it ready before they need it. Move 2. The cash buffer zone. This sounds almost too simple to matter. It might be the most important move on the list. You need cash, not invested cash, not I can liquidate this in 3 to 5 business days. Cash, actual sitting in a savings account cash. Boring, uninvested, slightly embarrassing cash, enough to cover 6 to 12 months of expenses. Researchers at Princeton have found that financial scarcity literally reduces cognitive function. When people feel financially vulnerable, they perform on cognitive tests like someone running on much less sleep. So during a market crash, if you do not have a cash buffer, every financial decision you make is being filtered through a brain operating at diminished capacity, a separate body of work out of the Federal Reserve Bank of St. Lewis found that households with even modest emergency savings were far less likely to make panic-driven financial decisions during downturns. The cash did not just protect them financially, it protected them neurologically. The cash buffer zone is not really about the cash. It is about what the cash does to your nervous system. When you know rent is covered, when you know groceries are handled, when you know a job loss does not mean financial annihilation, your brain shifts out of survival mode. And that shift is what allows you to make the kinds of decisions that build wealth during the exact moments when everyone else is destroying theirs. People skip this move because cash sitting in a savings account feels like failure. It feels like opportunity cost. It feels like watching your friends earn 9% while you earn 4%. Until the day comes when their 9% becomes negative 20% and they need cash they do not have, and they sell at the worst possible moment to get it. Then, your boring savings account looks like armor. Move 3. The rebalancing trigger. Most people think of portfolio rebalancing as a boring maintenance task, something you do once a year at tax time. During a crash, it becomes something closer to a legal cheat code. Picture your target allocation at 80% stocks, 20% bonds. Markets crash, stocks drop 40%. Suddenly, your portfolio is sitting closer to 67% stocks and 33% bonds. Every instinct in your body is telling you to sell more stocks and run further into bonds. Get to safety, reduce the pain. Rebalancing tells you to do the exact opposite. Sell some bonds. Buy more stocks. Bring the ratio back to where you started. Research from Vanguard's investment strategy team has shown that disciplined rebalancing during the financial crisis added a small but meaningful amount to annual returns compared to portfolios that were left to drift. That sounds tiny until you compound it across 30 years. On a $500,000 portfolio, it can be worth 6 figures of additional wealth from one habit. You cannot rely on yourself to do this when markets are in freefall. That is exactly why Move 1 exists. You set the rebalancing on a schedule or on a percentage trigger, and you let the system execute. No phone calls, no decisions, no sitting at your desk arguing with your amygdala about whether this time is really different. The whole point is the paradox. The optimal move feels psychologically wrong. Buying more of the thing that is hurting you. Leaning into the pain instead of away from it. Every instinct screams against it. That is precisely why the people who automate this decision outperform the people who try to make it in real time. The market does not reward your bravery. It rewards your absence from the keyboard at the moment the bravery is needed. 3 down. The next 3 are where most people quietly fall apart, even when they have the first 3 locked in. Because the first 3 protect your portfolio. The next 3 protect the only thing that actually keeps the system running. You. Move 4. Income diversification. Most crash content ignores this completely. That is a mistake. Because market panics rarely stay in the market. The 2008 crash bled into the job market within months. The 2020 crash shut down entire industries overnight. The next one will do something similar, because they always do. And when your investment portfolio is dropping at the same time your income feels threatened, that is when the truly destructive decisions happen. That is when people empty retirement accounts at a 40% loss and pay the early withdrawal penalty on top of it. Work out of the National Bureau of Economic Research has found that households with multiple income streams were significantly less likely to make early retirement withdrawals during recessions. Not because they earned more in total, because the psychological security of knowing that if one stream failed, another existed, was enough to short-circuit the panic cascade. This is not about hustle culture. This is not about grinding 80-hour weeks. It is about strategic redundancy, a side income from freelancing, rental income from a small property, dividend income from a portfolio you have been quietly building. Even a modest secondary stream changes the math entirely because it changes the psychology entirely. One income source during a crash is a single point of failure. Your brain knows this even if you have never put it into words. And that knowledge, the awareness that everything depends on one paycheck, is what turns a normal market correction into a personal financial crisis. You do not need to replace your income. You need to supplement it just enough that your brain stops treating every economic headline like a survival threat. The financial redundancy is a bonus. The psychological redundancy is the real prize. Move 5. The anti-news protocol. This one will sound counterintuitive, maybe even irresponsible. The research is overwhelming. During a market panic, consuming financial news makes you poorer. Not metaphorically, measurably. Researchers at Berkeley found that investors who consumed financial media daily during volatile periods traded substantially more often than those who checked their portfolios quarterly, and that increased trading reduced their returns over time. Across a 30-year career on a normal-sized portfolio, that single habit can cost 6 figures in lost wealth. Not from bad investments, from bad information consumption. It gets worse. Financial news during a crisis is not designed to inform you. It is designed to activate you. Work from MIT's Media Lab has shown that emotionally charged headlines spread far faster than neutral ones across social platforms. The content reaching you during a panic has been algorithmically selected for its ability to trigger a fear response. You are not getting information. You are getting emotional manipulation wearing the costume of journalism. The protocol is simple. Set a schedule. Check your portfolio once a month. Read one financial summary per week. Not per hour, per week. Delete every financial news notification on your phone. All of them. Being less informed during a crisis often makes you a better investor, because the information you are consuming is not helping you make decisions. It is wearing down your resolve to stick with the decisions you already made. Every scary headline is another test. And every test costs willpower you cannot afford to spend. The anti-news protocol is the partner of the automation firewall. Automation removes the decision. The protocol removes the temptation to override the automation. You are not burying your head in the sand. You are protecting cognitive resources for decisions that actually matter. Move 6. The Opportunity Fund. The last move is the one that separates people who survive a crash from people who build generational wealth because of one. It is almost embarrassingly simple. You set aside cash, separate from your emergency fund, specifically designated for buying assets during a downturn. Warren Buffett's most famous line is to be greedy when others are fearful. Everyone knows it. Almost nobody does it. The reason traces back to neuroscience. Research at Cornell has shown that the brain processes potential gains and potential losses through entirely different neural circuits. Losses register far more loudly than equivalent gains. Behavioral economists call it loss aversion. During a crash, it becomes paralyzing. When the market is down 35%, the rational part of your brain knows stocks are on sale. The emotional part is screaming that buying more means losing more. And the emotional part almost always wins because it processes information faster, louder, and with more chemical authority than the rational part. The Opportunity Fund solves this by making the decision before the emotion arrives. You set the money aside in calm conditions. You decide in advance what you will buy and at what price levels. You commit. So during the crash, you are not making a brave decision. You are executing a plan that the calm version of you already made. Studies of institutional investors with predetermined crisis deployment strategies have shown them outperforming reactive investors by a meaningful margin in the years following a major downturn. Compounded across a career, that gap is the difference between retiring at 60 and retiring at 67, between leaving your kids an inheritance and leaving them nothing. The hidden cost is sitting on idle cash during good times, watching friends earn double-digit returns, while your fund earns 4% and patience, until the crash comes. and you are the only one shopping while everyone else is selling. Look at all 6 moves together and a pattern emerges. Not one of them asks you to be smarter. Not one asks you to predict the market. Not one requires a finance degree or a Bloomberg terminal or a guru's paid newsletter. Every single one does the same thing. It builds a system that protects you from yourself. That is the real secret of surviving a market panic. It is not about having the right information. It is about building structures that work when your brain will not. Automation when willpower fails. Cash when fear takes over. Rules when emotions start making the decisions for you. If this changed how you think about preparing for the next downturn, drop a comment telling me which of these 6 moves you are setting up first. I genuinely want to know which one lands hardest for you. And if this is the kind of finance content that actually makes sense, hit subscribe. There's a video on screen right now breaking down the 3 biggest mistakes people made during the 2008 crash that almost everyone is quietly setting themselves up to repeat. Click it before the algorithm forgets you are here. You are not broken for panicking during a crash. You are not weak for wanting to sell everything and hide the money under a mattress. You are running a brain that was optimized for a world where threats were physical, immediate, and required instant action. That brain is spectacular at keeping you alive. It is terrible at managing a retirement portfolio. The 6 moves do not fight your biology. They work with it. They accept that you will be scared, you will be irrational, and you will want to do exactly the wrong thing at exactly the wrong moment. And then they make sure the right thing happens anyway.